So we got the rate cut that we were hoping for. We got the rate cut that we were expecting. 25 basis point drop by the Bank of Canada. So now we have an overnight rate of 2.5%. And everybody with a mortgage is cheering and everyone is running out to buy property. Not exactly. The one thing that we can say is that it seems as though United States and Canada are kind of a little bit more closely aligned, especially when it comes now to their monetary policies. The Federal Reserve on the exact same day dropped interest rates by 25 basis points, citing a lot of the exact same issues that Canada is having. They're just being affected in a little bit of a different way. So tariffs, inflation, and labor. That's what Jerome Powell said the biggest concerns for the American economy were right now. Canada's seeing a lot of the same issues. Our inflationary problem is not as severe as the United States, although it still is kind of on the high end of what the Bank of Canada deems to be acceptable. We have got some serious issues with our labor market. We've spoken about that in the past, whereby it's difficult to see inflation increase and entrench itself if the labor market has a lot of slack, because it's hard for wages to increase as the products that are increasing in price increase. So it's not great for the consumer, but it does hold back on inflation. It does remove much of the threat of the inflation. And Tiff Macklin spoke about that in the meeting today. The biggest issue we've got in Canada right now is that investment in our country is frozen. Business confidence is at all-time lows. And now we're morphing into a country that is constantly searching for how to become more productive, which is a good thing in the longer term, but is a very challenging thing in the short term. We know that we're going to have to renegotiate CUSMA. We know that we're going to still be in for more pain with the United States. We know that certain sectors of our economy are going to perform poorly. We're already seeing that in the housing market. So, what does this mean for you? It means that you should take a long, hard look at a variable rate mortgage. We will definitely see another 25 basis point drop from the Bank of Canada. It's probably going to come in October. Right now, they've got the probability of that pegged. The economists have the probability of that pegged at about 40%. I think we're going to slowly start to see that increase. I think that wherever one rate cut begins, you're going to see another rate cut soon after. And I think that because of the weakness in our economy, we will continue to see rate cuts in 2026. The only way we do not see rate cuts in 2026 is if magically we get this amazing new CUSMA deal with Donald Trump in the United States. And as a result, our economy starts firing on more cylinders. One phrase that stood out for me, and I'll read it for you from the Bank of Canada today, was the Governing Council is proceeding carefully with particular attention to the risks and uncertainties. I feel that this is going to rein the market in from overly aggressive rate cuts, expecting overly aggressive rate cuts. I am confident that we will see continued rate cuts. You can see it in our Government of Canada bond yield. So I'm going to put that up right now for you. So the 5-year Government of Canada bond yield is at it's the lowest that it has been since March. It's at about 2.7% right now. And that's putting downward pressure on fixed rates. It's going to continue to put downward pressure on fixed rates. It just will continue to take time. So if you're looking for a fixed rate, great fixed rates available, like nothing starting with a 4 anymore. But I think you're going to leave a little too much on the table, and I think you really have to consider a variable rate mortgage right now. There are no real tailwinds for the Canadian economy. There are only headwinds. And when we're in a situation like that, we are tending to see the central bank loosen its policy and provide for more rate cuts. I got a few questions that came in from some clients. So one was, how is it that the US is fine and we're in trouble? Well, that's not the case. As we spoke about a little bit at the beginning of this, US inflation was up in August, and now they've decreased rates. So their inflation was up even more. Their inflation reading's higher than Canada's, and they're decreasing interest rates because they're worried about what's happening with their economy. The job market is getting weaker in the United States, not as weak as it is in Canada, but it is getting weaker. And then finally, the pain of the tariffs are still coming. They're still there. They were just a little bit delayed, and now they're starting to surface in the economy. And that's what Jerome Powell in the Fed decisions started to discuss. Okay, another big question. Everyone's thinking it. Is this the rate cut that will resurrect the market? No. The market is not just going to get resurrected. We may see a slow and gradual increase in home prices, but we could just as likely see continued decrease in home prices for the rest of 2025 and the beginning of 2026. We're going to see rates come off, and hopefully that stimulates our housing market. But this one rate cut is not going to mean that the housing market's going to start booming. Last one, why didn't fixed rates go down? So fixed rates were going down in advance of the Bank of Canada meeting. It's important for us to recognize that the relationship between variable rates and fixed rates and what's going on in the economy is a little bit different. Fixed rates are an instrument that are priced off of bond yields, and those bond yields increase or decrease in anticipation of what the Bank of Canada is going to do. So it's relatively priced in by the time the Bank of Canada meets, unless there's a big surprise, in which case you may see a change in bond yields. So because we expect variable rates or the prime rate to continue to drop over the next 12 to 18 months, we can expect to see bond yields continue to go lower. And as they go lower, we'll see 5-year fixed rates drop. I think for now, anyone that's in a fixed rate mortgage should have a look at what it takes to break that mortgage, because as we talk about a lot, penalties to break fixed rate mortgages are priced off of what interest rates are and how fixed rates mortgages are behaving. So as fixed rates drop, penalties to break fixed rate mortgages increase. So if you are considering switching to a variable rate mortgage, reach out to us. We'd love to price that for you. We can go through what it costs to break your existing mortgage and the savings associated with switching to a variable rate. It might not always make sense, but in a market like this, you do not want to risk not having a fully optimized mortgage. Thank you very much.